Hey all, welcome to ShareTrack. This is Raj here. And friends, I'm so delighted that I have wonderful viewers and subscribers. In the past, our long-time viewer, John Pagakis and Sam, joined me and helped create content. They had done a 3-part series, I think, on covered calls, and it was a fun thing to do, collaboration. Many of you must have seen that, and some of you definitely did like it. You liked it a lot, and so I'm very grateful for that. And remember, last few days I was saying I was not feeling that great. I was feeling a bit burnt out. So our good friend Inf, also known as Sandeep Chahal, he lives in Greater Toronto area. So he called me up and said, "Raj, if you want, I can do something for you." So I said, "Why not? Why not jump over here? Because I don't do much of fundamentals. I'm too lazy for that." And Sandeep said, "Yeah, I can do a segment on fundamental analysis." So today I present Sandeep.
Hey there, friendos. Big thanks to Raj for introducing me. My name is Sandeep. Some of you folks in the comments might know me as INF, that guy who keeps saying based and a bunch of other weird fun stuff. But anyway, I have the great pleasure, thanks to Raj, to come here and talk to you about some of the great ways that we can use to analyze a company. Now, there are a few ways to analyze, to value a company. Raj does a phenomenal job of taking a look at the technicals when he shows the trading view chart. There are other ways where you could listen to the earnings call. You could listen to what the people in management who are there day to day and know what's going on, what their perspective is on the company, and what some of their things coming up are. We've had Jeff on the channel before who's talked about some great strategies like covered calls, but today I am going to run you through a quick way to do fundamental analysis in much fewer than 30 minutes. And you might think, how are you able to do fundamental analysis in such a short amount of time? The emphasis is going to be on the word quick. So this isn't going to be the full fundamental analysis, but it's going to be a quick Cliff Notes version of how we're going to do that. So first of all, what we're going to do is we're going to, depending on where you are, we're going to open up either the SEC and go to Edgar if you're in Canada, or if you're going through a Canadian company, the place you want to look at is CDAR. So let's go ahead and open that up right now. Now, when you open up the Edgar website, you're going to first of all try to find the company you want to analyze. In our case, we're taking a look at a favorite company of the genomics channel, CRISPR Therapeutics. You're going to see a whole bunch of fun stuff. You're going to see 8K, 10K, a bunch of other words. You don't need to worry too much about that, but the quick Cliff Notes version of all those 10K, 8K is when you see K, that means annual. When you see Q, that means quarterly. And 8 means it's just something that the company put out regards to events. So if they're doing a share offering, if somebody from the company is announcing something cool that's going on, which is going to be really, really great in the genomics sector because they're announcing things in their pipeline all along. When you see the word 10, that has to mainly do with financials, and that's what we're going to utilize here today. Financials and fundamentals. Oh, by the way, we take a look at an 8K earlier, and we saw that CRISPR Therapeutics actually, they just this week approved a 1.7 million share offering. So anybody who's a shareholder in CRISPR Therapeutics is going to have to keep that in mind for whenever the company wants, they can raise cash. So when we're doing fundamental analysis, first of all, we'd like to always start off with a cash flow statement, because cash is incredibly important, especially in a high interest rate environment like we are in today. Cash is one of the most key things. By the way, another fun little note. If you ever want to know what a company does, like just a really simplified version of what a company does or what the company's doing, and what you want to do is just go to the company's annual filings, and they have like a really, really simplified version of what the company does and what the company is about. So first of all, let's take a look at the cash flow statement. Great important thing is that all these numbers are in thousands. That means that we will multiply these numbers by 1,000. Okay, the first thing we'll notice here is that this quarter, 2023, we had a very significant increase in net income, which shows if you do a little bit of quick math here, a $126 million lower net loss than we did the prior quarter, which is a great sign when we get things going. The next thing I like to do is we take a look at the operating activities, and that's over here. We could see a great big change in net cash from operating activities, where in the prior quarter we were losing $135 million, and now we're gaining about $8.8 million. And that's an amazing improvement, especially in an environment where everyone's throwing around the word recession every now and then. Typically, you don't see a big increase like this in a recessionary environment, so take that for what you will. The next step I like to do is take a look at the investing activities, and normally in this line over here you see an item called CapEx, capital expenditure. That is what the company uses, or what the company calls for items like research and development, property, plant, equipment, acquisition and merger costs, technology expenses. However, for CRISPR Therapeutics, it looks like their only CapEx for this quarter was a $3 million loss in property, plant, and equipment, or purchasing property, plant, and equipment, which is not too bad. So what we like to do in this case, by the way, you could take a look at this. Like, you don't have to take a look at this on the SEC website. You could find all this information on Yahoo Finance, on MarketWatch, on Morningstar, whatever you like to do. It's just a financial statement. So what I'd like to do next is I take that $8.8 million that we got from operating activities, and I subtract the $3.06 million we got in CapEx, and that's how we arrive at free cash flow. Free cash flow is something where the company has this much money just for day-to-day operations. So we do a little bit of quick math here. 8.8 subtracted 3.06 million. We get a free cash flow that amounts to about 5.739 million. So 5.7 million, just for easy math, over 3 months. I've taken a look at a whole slew of financial statements, and 5.7 million in free cash flow in 3 months. I gotta admit, that's really good. And this company, CRISPR, has an unfortunate history of losing money. So this is a very welcomed, very, very nice change. Now that we've taken a look at all this fun stuff, we can look down and see that their cash and cash equivalents at the end of the quarter from the beginning quarter was $344 million. So that's how much cash they have at the end or as of March 31st of this year. And this is going to be very important when we go take a look at the balance sheet. You're going to see a great little area here called financing activities. Now, if the company did something like a share offering, or if they paid dividends, or they did stock buybacks, this is the area you would find a lot of that fun stuff. In our case, we don't need to worry too much about that because the company didn't use a bunch of their cash to satisfy the shareholders. Now we see and what we find very, very interesting here is the cash at the beginning of the period of $224 million increased to $356 million, which is a very, very nice increase, about $132 million if we do some quick math in my head. However, if we take out the restricted cash, $344 million in cash, that's how much we have right now for sitting in the company to do day-to-day operations. Now, the next thing I like to do is move over to the balance sheet. A lot of accounting nerds, a lot of accounting enthusiasts, or I should probably say, are really, really happy about this right now. Accounting homies, wherever you are, I don't know, say shout out that you notice that we're dealing with a bunch of accounting fun stuff right now. Anyway, what we see over here in the assets section, the very same number, that cash and cash equivalents, is reflected right here. If we add in the cash and cash equivalents in addition to the marketable securities, now marketable securities, these are just some short-term securities that the companies like to buy. All companies have this. So these are things that they could turn to cash and are very liquid. They could turn to cash on short notice immediately. If we add these two numbers, we get about a number of $1.882 billion in cash. Some companies, you seek to see things like inventory or other sort of things in this area. I don't like to add in the inventory because that's more so added or considered operating cash. And inventory, you don't always get the cash value that they state for it. Anyway, that's a story for another time. So if we take our $1.882 billion we have in cash, remember that number, take a look at some of the liabilities. You'll see a few different areas. Current liabilities and long-term liabilities. So the current liabilities are short-term liabilities. These are your bills that you're going to need to pay in the next little while. Going to get your bills paid. You got to pay your hydro. You got to pay your electricity. In genomics, they're probably doing some other crazy complicated stuff. Who knows? But liabilities are actually $146 million, and the long-term liabilities, if we were to subtract this number from this number, we get long-term liabilities from about $243 million. Now, remember that $1.88 billion in cash that we figured out we got over here? If we consider $1.88 billion in cash and that we have about $146 million of short-term bills and a $243 million in long-term bills, we could pay off all of our liabilities right away if we wanted to. And speaking from experience, not all companies can say that. There are many companies in the S&P 500, many companies in the NASDAQ who cannot say that they have enough money to pay off all their short-term liabilities and long-term liabilities. So this is a very, very welcomed and very, very appreciated thing for our shareholders who are looking for a company that has enough cash and sustainability to stay afloat for a while, right? Now, the third part of our accounting fundamentals is we'll take a look at the income statement. Income statement just reflects where the company got a lot of its revenue, a lot of its money from. And if we take a look at a bunch of this fun stuff, I won't bore you with whatever's going on over here. You could take a look at that, but we could see that they had we could see that the loss from operations in the prior year was $176 approximately million, and now it's $64 million. You shouldn't really do this with money-losing companies, but if we were to consider this number and this number, that means that we have decreased our loss and increased our revenue by approximately 70%. That's a 70% revenue growth in 3 months. Now, one way to value a growth company is something called the PEG ratio, price to earnings growth ratio, PEG ratio. And you shouldn't really do this for money-losing companies. You should mainly do this for growth companies that actually have earnings. However, let's just do it for fun. The accounting homies out there are going to be quite excited that we're doing some accounting fun. So I went ahead and I took a look at the forecasted PE ratios for CRISPR, and what we got is a 7.33 loss in 2022, a 9.49 PE loss in 2023, a 10.29 loss in 2024. However, the company is expected to become profitable in 2025. In 2025, they expect to have a PE ratio of positive 340.22. Now, if we were to do a little bit of PE ratio projection over here, how that works is we take the current price to earnings and we divide it by the growth, the expected growth. In this case, we don't really have earnings in 2023, but if we were to project into 2025 and take that 340 or 340.22 expected PE, forecasted PE, and take the current 3-month revenue growth rate of 70%. And just to give you some perspective, NVIDIA, they used to have a revenue growth rate of about 25%. And in their recent earnings, where they skyrocketed about 30% overnight, their revenue growth rate went from 25% to 30%. Of course, there was a lot more that had to go into this. This company is incredibly efficient. This is a great company, but just to give you some perspective. So if we take that 340, if we take that 340 and we turn it to a EPS, earnings per share for 2025, that's about a 0.18 earnings per share. We'll take the current stock price of CRISPR, which is about $62. Take that assumed 60% or so growth rate. What we'll do is price to earnings growth 340 divided by 60% growth. We end up with a 2025 PEG ratio of 5.67. Now, that's going to sound very, very high to growth investors because we've got companies like NVIDIA, which are trading at I think a 2.8 PEG ratio. We've got companies like AMD, which are trading at about a 1.9 PEG ratio. And this is going to trade at a projected forward 5.67. It's not great, but is great for genomics investors because this is a company that is going to have growth in 2025. It's going to have a lot of growth and a lot of ramping in 2025. And here's something else interesting that I figured out while going through this wonderful earnings statement is if we take a look at just down here in the outlook area, we take a look down here just in the outlook area, we see some very, very interesting things where they say that our expected existing cash will enable us to fund operations and expenditures for at least 24 months. If you do a little bit of mental math, 24 months will take us to 2025 when they're expected to be profitable, which is pretty nice. They talk about some other stuff like some risks, like they were talking about. They mention inflation here, where they don't think inflation is going to be a big deterrent, a big negative for them. But they talk about the foreign currency risk because this is a Swiss company. The exchange rate could be a negative, but they're just recognizing it. They also talk about later on, I noticed that they were talking about the banking failures, a bunch of the banking failures in America. They don't think it's a risk right now. However, they think that if this were to continue, if more banks to fail, it could be a potential risk, and they're just recognizing it for now. And that's some really quick way of doing some really quick fundamental analysis. Well, that was a very, very quick Cliff Notes version of talking about some fundamentals and doing some fundamental analysis. And this is a very, very easy way that any person with an internet connection can do. Like, you don't need the Bloomberg terminal, you don't need all this fancy technology. It helps because it gives you a bunch of summarized statements, it gives you all the ratios you want. And maybe that's something we take a look at another date. But I just want to thank you for paying attention and looking at this with me. It's been a wonderful time, and I love sharing all this accounting knowledge and all this financial analysis with you. So I'm going to snap my fingers, and we're going to bring Raj back. And thank you kindly, and I hope you had yourself a fun time. It was based.
Well, that's a big thanks to Sandeep for saving me from doing a video. And I think Sandeep had a good segment out there. Please put your comments below and give an encouraging hand to Sandeep. And if any of you want to collaborate with me and bring some really good information to our audience out here, please drop me a line, sharetrack@gmail.com, and we'll see if we can collaborate and put some nice content which everybody can enjoy. And that way our community is totally involved in the channel. With that, I would like to bring this video to an end, and I hope you guys have a great weekend. Bye for now.